And news from day two, the U.S. Federal Reserve says the economy is improving, but the labor market is still unstable. The central bank was optimistic on growth. In its June policy statement, it says the jobs and housing markets still have room to improve, and the Fed is also going to continue scaling back its monthly asset purchase program. Some call it printing money. But they didn't say that they were going to wrap up its stimulus package this year. The Fed was vague, though, on when they will raise rates. It said they're waiting for the job market to improve and the inflation to pick up before it acts. For more on this, Dean Baker is here with me on the set. He's the co-director of the Center for Economic and Policy Research. Good to see you again. Well, let's start with that. The Fed said they're not going to raise until those two things happen. Where do we go from that?
Well, I think that was very good judgment on the Fed's part, Janet Yellen, the Fed chair in particular. The issue here is, why would they start to raise rates? You have a lot of people that seem to be on the warpath. The Fed has to raise rates, the Fed has to raise rates. And obviously they've been low, they've been zero for a long time. But that's because the economy has been weak, the labor market's weak. And although we could say things are improving, they're improving at a very slow rate. So you're sort of hard pressed to say what would be the motivation? Why you don't raise rates as an end in itself. The idea would be you'd raise rates if you were worried somehow the economy is overheating, we have a problem with inflation. It's really hard to see that right now.
What's considered a hot economy in terms of a job? Let's just take one thing, for example. Let's take jobs. What's a big hot number that you'd say, wow, we're growing fast?
Well, if you go back to the early 80s, when we were coming out of the steep recession, 81, 82, we had months where we created over 400,000 jobs, and that was in a labor force that's about half the size of the current labor force. So if we saw 600,000 jobs, I'd go, I was impressed. But we're still down more than 6 million jobs from our trend growth path. So we have a lot of room to make up.
What happens if the jobs, let's say the jobs stay the same where they're at now, where you get a couple 100,000 every month, but inflation begins to pick up, wages begin to pick up, food prices pick up, gas prices pick up? Do we have a problem?
Well, certainly, if that were the case, if you really start to see, and it has to be substantial acceleration, because a moderate acceleration just means workers are getting their share of growth. So if wages growing around 2% a year now, if that went to 2.5, even 3, that just means workers are getting their share of growth. The problem would be if it started to go 3.5, 4, where you certainly would be seeing an issue of accelerating inflation. That's when the Fed really would have to start to slam on the brake.
Everybody loves property. We had kind of a weak number for a previous month of secondary homes that were sold. I wouldn't say it's like very weak, but people were expecting a little bit more. Is it a single data point or something we should extrapolate into a trend?
It is a single data point. It's important to understand these numbers are very erratic. You know, you're basically, if there's good weather one month, you're going to get more houses sold. You know,
in other words, we should ignore that.
That's right. You look for, if you see that 2 or 3 months in a row, then you start to worry. Now, what you could say is a longer-term trend, we're selling fewer homes than what we did last year. It definitely has slowed down. We had a very hot housing market early part of 2013. It's slowed. I don't see it further slowing, but we certainly are in a slower market today than we were a year ago.
When you think about the housing market and the number of jobs it creates, and a lot of people focus a lot on that, and obviously you need a job to buy a house. So you would think that as the unemployment rate continues to go down, the number of houses would increase. Is there anything wrong with that line of thinking?
Well, we're actually selling about as many homes as you would ordinarily expect. So if you took a trend line from the mid-90s to where we are today, we're about where that should be. Now, we're not where we were at the peak of the bubble. We're not where we were in 04, 05, 06 when, you know, houses were flying off the lots, you know, as quick as people could put them on there. But I think we're really selling about as many homes as you could reasonably expect.
I have a personal question for you, if you don't mind.
Sure.
So the unemployment rate is ticking down. And when it was high, people said, well, you couldn't negotiate, you know, any wages, and it was hard to ask for a lot of money. Well, now that the unemployment rate is at 6%, things are significantly better. Does that mean us as a group, professionals out there working in America, can begin to start thinking about a raise, say, next year?
Well, one would hope. We're not seeing that in the data yet. So I follow the wage data very closely, and there's really no evidence of an uptick in the rate of wage growth. So one would hope, you know, labor market is tightening, no doubt about that. So hopefully in the not too distant future, you will start to see a more rapid rate of wage growth.
Okay, your top concern for the U.S. economy?
Well, I would worry first and foremost that the Fed is pressured into raising interest rates too soon, because that I think is the biggest problem. I don't
Do you
see.
think Janet Yellen feels the pressure from that? Like,
Well, Janet Yellen's smart, very smart person. She's tough. She didn't get to be the first woman chair of the Fed by being a shrinking violet, but nonetheless, there's going to be a lot of people, and she doesn't decide policy by herself.
I got 40 seconds left, according to Alex, and just very quickly explain, why do we care whether the Fed raises rates or not? Why is that such a big deal? If they were to raise or not raise, whether it's January, February, March, April, May, you pick a month.
Well, the Fed raising rates, the Fed can't always speed up the economy. So the quantitative easing had some impact, probably not as much as they would have wanted, I would have wanted. They can slow down the economy. They raise rates, that's higher costs for car loans, mortgage loans, credit card debt. That will slow the economy, throw people out of work. That's a big deal.
So raising rates is basically the brakes you slam on to slow the economy down.
Exactly, and those would work much better than the accelerator.
Okay, that's a great explanation. Dean Baker, great to have you here.